Welcome to the One Deal Millionaire podcast, where we don't just bounce properties, we flip mindsets. I'm JD Allen, Marine Corps veteran, engineering leader, and your multifamily investment mentor. If you're stuck chasing small gains, we're here to change the game. Each week, we dive into strategies to bounce your way to your first million. No fluff, no hype, just real talk, real deals, and real momentum. Let me start with a confession. Earlier in my career, I chased deals with no focus. If it had a for sale sign on it, I looked at it. Duplexes, triplexes, small apartments, even mobile homes. And guess what? That lack of focus cost me over $20,000 on one property. Now here's the kicker. Years later, after I finally got crystal clear on my buy box, I closed a deal that made me over $1 million. In this episode, I'm going to show you the exact difference between those two moments. The difference between losing money and building wealth. And it comes down to something simple. Your buy box. See, when you're new to multifamily, everything looks like an opportunity. You scroll through LoopNet, you talk to a broker, you see 20 different kinds of deals, and suddenly you're dizzy. Which one's the right one? Should I buy a 6-unit, a 50-unit, a Class C rehab, a stabilized property? And it can become overwhelming. Here's the truth. When you chase everything, you catch nothing. You waste time, you frustrate brokers, and you risk buying something that takes you backward instead of forward. That's why your buy box is so powerful. It's not just a list of numbers or criteria. It's your lane. It's your weight class. It's the filter that says, this is the kind of deal I do. Everything else, I let it go. And today I'm going to break it down for you. We will cover what a buy box is, why it matters more than you think, how to build one step by step, the biggest mistakes that beginners make, and that story I promised, the one about how I went from a $20,000 loss to $1 million win. So if you've ever felt overwhelmed by too many deals, stick with me until the end. Because once you get this right, you'll never look at multifamily the same way again. Now let's jump in. What is a buy box? Think of your buy box as your investing compass. It's the filter that tells you exactly what kind of property you're looking for, and just as important, what kind of property you're not looking for. Without it, you're like a wrestler stepping onto a mat without a weight class. You don't know if you're facing someone 20 pounds heavier or 50. You're unprepared and you're going to get tossed around. And in real estate, if you don't have a buy box, you'll look at too many deals, waste time underwriting properties that are not going to fit your goals, and risk buying something that takes you backward instead of forward. Now let's flip it. With a buy box, you have clarity, you know your lane, you know that weight class, and you know exactly where you belong. And that confidence does 3 things for you. It saves you time. You instantly know if a property fits. You can underwrite it faster, make decisions faster, and move when it's not right. It builds credibility. Brokers, lenders, and sellers want to know that you're serious. And if you tell a broker you're looking for a 10 to 30 units, Class C, in a secondary market in North Carolina with value add potential, they are going to take you far more seriously than someone who says, I'm going to buy anything you got. It protects you from emotion. When you're new, it's easy to get excited. You're going to fall in love with the wrong deal. You're going to justify those bad numbers, and you end up overpaying. A buy box will keep those emotions in check. So what goes into a buy box? Here are the core elements. Market. Which cities or regions are you willing to invest in? Property size. Are you targeting 5 to 20 units or 50 to 100? The asset type. Are you focusing on a Class B or Class C value add? Financial profile. The minimum cap rate, minimum cash on cash return, rent growth potential. Deal type. Do you want stabilized properties, distressed, or mom and pops with upside? When you put all these together, you create a filter, and that filter becomes your compass for every decision you make. So now that you know what a buy box is, let's talk about why it matters so much. Because here's the thing. When you're new, it's tempting to say, I'll look at everything. I don't want to miss out. It feels smart. It feels like you're keeping your options open. But the reality, that's the fastest way to spin your wheels, waste time, and frustrate every single person around you. Now let me break down the 3 biggest reasons of why I have a buy box and believe it is absolutely essential. Number 1, it saves you time. Time is your most valuable resource. Without a buy box, you'll waste hours underwriting properties that never made sense in the first place. You'll chase deals outside of your goals, outside of your budget, and outside of your expertise. I can't tell you how many early mornings I spent crunching numbers on deals that I should have thrown in the trash the minute I saw them because they didn't fit what I was trying to do. And with a buy box, it's different. If a property doesn't fit, I don't even waste 5 minutes. I move on instantly, and that speed and that clarity is a competitive advantage. Because here's the truth. Brokers send the best deals to people who can respond fast and with confidence. Number 2, builds credibility. Brokers smell a newbie a mile away. If you walk in saying I'll buy anything, they know you're not serious. But if you walk in and you say I'm looking for a 10 to 30 unit Class C in a secondary market in the Carolinas with a value add potential, you've just positioned yourself as someone worth paying attention to. Now the brokers know you have a lane and you have discipline. And let me tell you this, the brokers talk. If you waste their time, they won't call you back. But if you're clear, they'll put you on the short list when the right deal hits their desk. Your buy box is not just about filtering properties. It's about building a reputation. And in real estate, reputation is currency. Reason number 3, it prevents emotional buying. Now this one might be the most important. When you don't have a buy box, it's easy to get excited. You walk into a property, you fall in love with the look of it, and suddenly you're telling yourself stories to justify the deal. You're saying things like, well, maybe the neighborhood's going to improve, or maybe I can stretch this rent a little higher, or maybe I can figure out the financing later. And that's how people overpay. And that's how people lose money. I know this because I've done it. Remember that duplex in Eden? That was an emotional buy. I had convinced myself it was a good deal because I wanted it to be, and it wasn't. And it ended up costing me more than $20,000. Now, if I'd had a buy box, I would have walked away. And here's the beauty of it. Once you have a buy box, you can let go of bad deals without guilt. If it doesn't fit the buy box, it's a no. End of story. Wrap it up. Think of it like being an athlete again. A wrestler doesn't fight outside of his weight class, and a runner doesn't sprint outside of the lane. If they do, they lose. And in real estate, if you don't have a buy box, you're out of your weight class and you're running in the wrong lane. But with a buy box, you are focused and you're disciplined, and that's when you start to win. So here's the bottom line. A buy box saves you time. It builds that credibility and it keeps your emotions in check. It's your compass, your filter, and your protection. And in the next section, I'm going to show you exactly how to build one step by step so you can stop wasting time and start moving toward the deals that are going to actually change your life. So how do we build a buy box? Now that we know what a buy box is and why it matters, let's talk about how to actually build one. Because here's the mistake that I see made all the time. People believe that a buy box is just a random list of preferences, and it's not. It's a strategic framework that keeps you disciplined. And here's the framework that I use, and it's the same framework that I teach in the bounce method. Step 1, start with your goals. This is where most people skip ahead, but it's the foundation. Ask yourself, what am I really trying to accomplish with this real estate deal? Are you focused on cash flow, like steady income month to month, or are you focused on appreciation? Buying properties that may not cash flow much today, but will be worth significantly more in the future. Or maybe you want a mix of both. Your answer will determine everything else. For example, if your goal is the cash flow, you might focus on smaller, stabilized properties in steady working class market. If your goal is appreciation, you might lean towards properties in growing cities where rents are climbing fast. Clarity on your goal is step one, and without it, your buy box will collapse. Now, step two, let's pick our market. This is where investors spread themselves too thin. You don't need to know every market. You need to master 1 to 3 of them. Why? Because every market has its own rhythm, its own job base, tenant demand, landlord laws, even hidden quirks with taxes and insurance. Now, I like to focus on secondary markets. Why? Because job growth, population growth, and affordability. For you, it might be your backyard or maybe a city a few hours away. Here's the test. If I dropped you in that market and asked you to explain the top 3 employers, the best submarkets, and the average rents, could you do it? Now, if the answer is no, you haven't learned much about that market. So keep it tight, 1 to 3 markets, and master them. Step 3, decide on the property size. This is where beginners get lost. Should I start small or should I go big? And here's my advice. For your first deal, target 5 to 30 units. Now, why that range? It's big enough to create economies of scale, 1 roof, multiple tenants. And it's small enough that you're not competing with the big institutional players. And it's a size that local banks are often comfortable lending on. A 6 unit, a 12 unit, a 20 unit, those are perfect starter multifamily properties. You're going to learn the ropes, but you won't drown. Now, step 4, define the condition. Now, you've got to be honest with yourself. Do you want stabilized properties with higher occupancy, predictable income, and minor improvements? Or are you comfortable taking on distressed properties? Maybe 60% occupancy, lots of deferred maintenance, and heavy CapEx need. Here's the key. Don't fool yourself. If you don't have the stomach or the capital for a heavy renovation, then don't put that in your buy box. But on the other hand, if you got the grit and the cash reserves and the right team, buying those ugly properties can lead to your biggest wins. For me, I personally like those value add properties, the messy ones, the ones that have the bad books, and the ones where there's going to be a lot of upside. Step 5, set your financial metrics. This is the backbone of your buy box. You've got to decide what's the minimum return that will be acceptable to you. For me, minimum cap rate of 6%, a cash on cash of at least 8%, and at least $100 per unit rent growth potential. Why? Because those numbers will give me margin. They're going to give me a little bit of breathing room. Now, your numbers might be different depending on your market, but the key is set them in advance. Because once you're in the heat of the deal, it's too easy to bend the numbers to fit your emotions. The buy box protects you from that. Step 6, decide your financing strategy. Now, this one is often overlooked. Are you looking for bank loans, or are you open to creative financing like seller financing, master leases, carrybacks, joint ventures? If you don't know yet, start simple. Banks, agency debt, SBA loans, whatever you can qualify for. But as you grow, creative financing will open doors you never thought were possible. For me, seller financing has been a game changer. I've done deals with 10% down, with flexible terms, because I was open to structure outside of the traditional bank box. So decide up front, are you a straight bank buyer, or are you willing to get a little creative? Now that's the framework. Start with your goals, pick your market, decide on the size, define the condition, set those financial metrics, and choose your financing strategy. Do that, and you're going to have a buy box that's not just theory, it's a compass that you can actually use. Now let me tell you a story, because this is where I learned the hard way why a buy box is optional. When I first started investing, I didn't have one. I was chasing everything. Duplexes, triplexes, small apartments, mobile homes. If it had a for sale sign on it, I thought it might be my ticket to success. And because I had no filter, I bought a duplex, and it looked good on paper. But here's the problem. It didn't fit any strategy. It wasn't big enough to scale, it didn't have real value add potential, and it wasn't even a market I had studied. But I had convinced myself that it was going to work. That's what happens when you don't have a buy box. You let emotion start doing the buying. And then disaster hit. 3 months in, a flood tore through the property. Water filled the basement. Units were damaged. Tenants were angry. And suddenly I wasn't collecting rent. I was writing checks. By the time it was over, I had lost more than $20,000 just like that. And it hurt. Not just because of the money, but because I knew deep down it was avoidable. If I'd had a buy box, that property wouldn't have even made it into my radar. But here's the flip side. After that loss, I got serious. I sat down, I built a buy box, and I said, I want 10 to 30 unit properties in a secondary market. I want mom and pop sellers with bad books, and I want properties with clear value add upside. And that became my compass. And then I stuck to it. And not long after that, a broker brought me a 17-unit deal. Messy, poor financials, deferred maintenance, high vacancy, and most people would have walked away. But because it fit my buy box, I knew it was exactly the kind of deal I wanted. So I bought it. I operated it with discipline. I upgraded the units. I normalized those numbers, and when I exited, that deal put over $1 million in my pocket. Now think about that. The difference between losing $20,000 and making over $1 million wasn't luck. It wasn't timing and it wasn't focus. It was the discipline of having and sticking to a buy box. And that's why I'm so passionate about this step. Because I've lived on both sides, the pain of chasing everything and the reward of focusing on one clear lane. And when you get this right, it does change everything. Now here are the 4 biggest mistakes I see and how you can avoid them. Number 1, being too broad. This is probably the most common, and a new investor comes in and says, I'm going to buy anything anywhere. At first it sounds smart, like you're flexible, you're open-minded, but here's what is actually happening. You waste time underwriting properties that don't fit your strategy. Brokers don't take you seriously because they can't tell what you actually want. And worst of all, you don't build expertise in any single lane. Your buy box has to be focused enough that people know what you're after. Mistake number 2, being too narrow. On the flip side, some investors swing too far the other way. They'll say things like, I only want a 12-unit property on this one street, in this one zip code, built after 1995 with washer dryer hookups in every unit. Now don't get me wrong, clarity is good. But if your buy box is too tight, you're going to starve. Deals don't show up every day. And if you boxed yourself into the tiniest corner of the market, you'll sit around waiting instead of building momentum. Remember, your buy box should filter deals, not choke them out. Mistake number 3, changing it every week. This one completely kills your credibility. A broker calls you with a deal and you say, well, I'm only looking for 20 to 40 units. The next week you say, actually, I'll look at duplexes. The week after that, I might be in a 100-unit syndication. Pretty soon, the brokers stop calling because you look like you're chasing a shiny object. Consistency builds trust, and trust is what gets your first call when a broker has a real opportunity. So once you set your buy box, stick to it. Number 4, not communicating it. This one might surprise you, but it's huge. Some investors keep their buy box in their head. They never actually tell brokers, lenders, or partners what they're looking for. And here's the problem with that. If nobody knows your buy box, how can they send you deals that are going to fit it? Your buy box should be part of every conversation. When a broker asks you what you're looking for, tell them. When you meet a lender, tell them. When you're networking, tell them. Because the more people that know your buy box, the more opportunities will come your way. Now let's recap. Don't be too broad. Don't be too narrow. Don't change it every week. And don't keep it to yourself. Avoid those mistakes, and your buy box becomes one of the most powerful tools in your investing journey. Now let's bring this all together with a strong close and talk about how your buy box fits into the bounce method as a whole. Your buy box is your compass, it's your weight class, it's your lane on the track. Without it, you'll waste time, frustrate brokers, and risk buying deals that don't fit your goals. With it, you gain clarity, credibility, and discipline, and that's what leads to $1 million wins. Think back to the story I shared earlier. When I didn't have a buy box, I lost more than $20,000 on a duplex. Chased the wrong property because I didn't have direction. But when I got focused, when I defined my buy box, stuck to it and communicated it, I landed a 17-unit property that made over $1 million. It's not luck. It's not timing. It's focus. It's discipline. And that's the power of a buy box. Tie it to the bounce method, and here's the bigger picture. The buy box is just one part of the bounce method. The B in bounce is buy, and that's where your buy box lives. But it doesn't stop there. Once you buy, you've got to operate with discipline, upgrade the property, normalize those numbers, cash flow to keep your business healthy, and eventually exit, either through refinance or sale, and then roll it into your next deal. That's the full cycle, and that's what we talk about on thebouncemethod.com. That's how you will go from one deal to financial freedom. And it all starts with this one step, building your buy box. So here's what I want you to do today. Not tomorrow, not next week, today. I want you to sit down and write out your buy box. Get clear on your goals, pick your markets, decide your property size, define the condition you're comfortable with, and decide on your financing strategy. And then share it. Tell the brokers, tell the lenders, tell partners. The more people who know your buy box, the more deals will come your way. That's it for today's episode of the One Deal Millionaire podcast. If you got value from this, share it with a friend who's ready to stop playing small. And remember, wealth isn't built by watching, it's built by moving. So take what you learned, apply it, and keep the velocity of money working in your favor. Subscribe, leave a review, and stay in the loop at thebouncemethod.com. And until next time, keep bouncing forward.